could suggest that investors are concerned about the inflationary impact.
Israel and Iran are now locked in direct conflict for a fourth straight day, with both sides trading missile strikes and civilian casualties rising. Iran has signaled it would like to de-escalate, but it's not yet clear how Israel will respond. Investors are watching very closely as volatility spikes across global markets. I want to bring in Marta Norton, Empower's chief investment strategist now. Marta, walk us through what triggered this sudden escalation.
So I'd call out the highlights as threefold. First, Israel has said that Iran is very close to developing a nuclear weapon. Second, that Iran believes is focused on the destruction of Israel. And third, that due to recent Israeli attacks on Hamas and Hezbollah, Iran is a bit more weakened, and so now seem the opportune time to press the advantage.
And the market reaction was immediate. Oil prices surged, at one point up more than 13%. Stocks around the world did pull back sharply, though those price movements have reversed today. So what does this tell us, Marta, about how investors are viewing the market impact of the war?
Well, the concerns seem to be centered around oil. That's kind of the epicenter of the investor interest right now. And that relates not just to the production of oil, but really the transportation of oil as it snakes its way through the Middle East and makes its way to the rest of the world. So any embargo or issues that constrain that transportation is something that investors, oil markets are going to be watching. And that's part of why we saw, I believe, stocks down on Friday. What was interesting is we didn't see much movement in the Treasury market. Typically, that's a risk-off trade. And when we don't see much of a rally there, it could suggest that investors are concerned about the inflationary impact.
So when it comes to inflation, how worried should we be about this conflict pushing inflation higher, especially with energy prices already elevated?
Well, conventional wisdom tells us that the Fed typically looks through headline inflation. That means inflation plus inflation in food markets and in energy markets. And the Fed is really concerned about those inflationary trends within the core, the broader economy. But we have seen developments such as these oil shocks contribute to higher inflation, most recently when we saw Russia invade Ukraine. So this is coming, it is a potential impact, and it's coming at a tenuous time where inflation has moderated, but we are expecting and anticipating some impact from the tariffs on the prices of core goods. So really, it's all just adding to the uncertainty of the moment.
If we look ahead, Marta, do you think this conflict could have a longer term impact on the global economy, or is this more of a short term market shock?
This is your classic geopolitical event, which is incredibly hard to forecast. As a reminder, just look back to when Russia invaded Ukraine. Almost all pundits were saying that this was something that was going to be over in a heartbeat, that Ukraine would fold. That's what the average person thought as well. And yet, years later, the conflict drags on. So what I think this is really doing is making the case for diversification. Having a portfolio that's broadly spread across a variety of assets that don't respond in the same way, and with investors looking at this volatility as a way to take advantage of lower prices when they emerge.
So sounds like your key takeaway for investors: geopolitical events like this one are impossible to forecast. And it's a reminder for all of us to stay grounded in our financial plans and keep our portfolios well diversified.
Absolutely.
Great perspective as always, Marta. Thank you so much. And we'll continue to monitor this situation and share updates as things develop. Don't forget, we're going to be back on Wednesday right here to break down the Fed's decision on interest rates. Have a great week.